This wasn't a pullback. It was an execution. In less than 72 hours, gold went from breaking records to breaking portfolios. No war was declared. No pandemic emerged. No central bank made an emergency announcement. And yet, gold futures collapsed with surgical precision, wiping out months of gains for leveraged traders while physical premiums actually increased. If that contradiction doesn't make you pause, you haven't been paying attention. By the end of this video, you'll understand exactly who benefited from this move, how the mechanism works, and why this same pattern has repeated at least 3 times in the last 15 years. This is Jack Goldsman. Welcome to the Hidden Economy. If you're new here, this is where we decode the moves that Wall Street hopes you never understand. I'm not going to ask you nicely to subscribe. I'm going to tell you directly. If you want to stop being the exit liquidity for institutions, hit that button now and turn on notifications. What I'm about to show you isn't speculation. It's a documented mechanism that gets deployed every time gold threatens to expose the fragility of the paper financial system. And let me be clear from the start, this is not financial advice. I'm not telling you to buy, sell, or hold anything. I'm showing you how the game is played so you can make your own decisions with open eyes. Let me walk you through exactly what happened. On Tuesday, gold was trading near all-time highs. Momentum was building. Retail traders were piling into futures contracts with maximum leverage, convinced that the breakout was real. The financial media was running headlines about inflation hedges and safe havens. Everything pointed to continuation. Then, late Tuesday evening, the CME group quietly announced an increase in margin requirements for gold futures. The change would take effect within 24 hours. Most retail traders didn't even see the announcement until Wednesday morning. By then, the first wave of liquidations had already begun. The increase wasn't small. We're talking about a significant percentage jump in the capital required to hold each contract. For a trader running at high leverage, this meant one of two things: deposit more money immediately, or watch your position get forcibly closed. And here's what the financial media won't tell you. This announcement came after market hours, giving institutional players with overnight trading desks a massive informational advantage. By Wednesday afternoon, the cascade was in full effect. Stop losses were triggering in waves, each wave pushing price lower, each lower price triggering another wave of margin calls. This is what a liquidation spiral looks like. It feeds on itself. The traders who were most bullish, most leveraged, most exposed, they were the first to get carried out. And the speed was breathtaking. We're not talking about a gradual decline over weeks. We're talking about a violent repricing that happened in hours. Before most people on the West Coast had finished their morning coffee, billions of dollars in gold futures positions had been liquidated. The question you should be asking isn't whether this was legal. Of course it was legal. The CME has the authority to adjust margins at any time for risk management purposes. The question you should be asking is, who knew this was coming? And who was positioned to profit from the chaos? Now let me explain the mechanism, because this is where most people get lost. A margin requirement is essentially a down payment. When you buy a gold futures contract, you don't pay the full value up front. You post margin, which is a fraction of the total contract value. This leverage is what makes futures trading so attractive and so dangerous. If gold goes up, your gains are amplified. But if gold goes down, or if the exchange raises your margin requirement, you suddenly need more capital to maintain the same position. Think of it like renting an apartment. You signed a lease at a certain monthly rate, and you budgeted accordingly. Then your landlord shows up mid-month and says the rent just increased by 30%, effective immediately. You have 24 hours to come up with the extra money, or you're out. That's what a margin hike does to leveraged traders. It's not a market force. It's an administrative decision that creates market consequences. But here's the part that most people miss entirely. The paper gold market and the physical gold market are two completely different animals. When the CME raises margins and futures prices crash, that's the paper market repricing. But physical gold, actual bars, coins, allocated metal in vaults, doesn't care about margin requirements. Physical gold trades based on supply and demand for real metal. And during this exact liquidation event, something fascinating happened. While futures prices were collapsing, premiums on physical gold actually widened. Dealers were charging more, not less, for actual metal. The spread between the paper price and the physical price expanded dramatically. This is the tell. This is how you know the move wasn't about fundamentals. If gold as an asset was genuinely less valuable, physical premiums would contract, not expand. But when paper sells off while physical gets more expensive, you're witnessing a divergence between the screen and reality. The screen says gold is crashing. Reality says buyers are paying more to get their hands on actual metal. Screen versus reality. Paper versus physical. This distinction will save you more money than any trading strategy ever could. The supporting mechanism here is the dollar and yield relationship. When margin calls hit, traders need to raise cash quickly. The fastest way to raise cash is to sell liquid assets. Gold futures are liquid, so traders sell gold to meet margin calls, which pushes the dollar higher as global participants scramble for greenback liquidity. A rising dollar then puts additional pressure on gold prices, creating a feedback loop. Meanwhile, if treasury yields are spiking, which often happens during liquidity stress events, the opportunity cost of holding non-yielding gold appears to increase, giving fundamental analysts a convenient narrative to explain the sell-off. But notice what's happening here. The narrative follows the price action, not the other way around. First, the liquidation happens, then the explanations emerge. The financial media will tell you gold fell because of dollar strength or rising yields. What they won't tell you is that the liquidation itself caused those moves. The tail is wagging the dog. Now, if you're thinking this sounds like a one-time anomaly, let me disabuse you of that notion immediately. This exact pattern has played out at least 3 times in recent history, and probably more if you dig deeper. Let's go back to 2008. Gold was rallying as the financial crisis unfolded. It made sense. The banking system was imploding. People wanted safety. But then, in the depths of the crisis, gold suddenly crashed. Why? Margin calls. Liquidity crisis. Forced selling across all asset classes. The paper price collapsed while physical buyers scrambled to find available metal. Premiums exploded. The mechanism was identical. Move forward to 2011. Gold had been in a multi-year bull market, approaching $1,900. Then the CME raised margin requirements multiple times in quick succession. Each hike triggered another wave of liquidations. Gold went from all-time highs to a bear market in weeks. The media blamed it on dollar strength, on improving economic conditions, on reduced inflation fears. But the trigger was administrative. Margin hikes that made it impossible for leveraged bulls to maintain their positions. Once is an accident, twice is a coincidence. Now look at March 2020. Gold was supposed to be the safe haven as the world locked down. Instead, it crashed alongside stocks in a liquidity panic. Futures plummeted. Physical premiums went vertical. Dealers ran out of inventory. The paper price said gold was worthless. The physical market said it was priceless. Same mechanism, same divergence, same beneficiaries. 3 times is a pattern, and the pattern is this. Whenever gold threatens to rally too far, too fast, in a way that undermines confidence in paper financial assets, the margin requirements get adjusted, the liquidations cascade, and leveraged retail traders get wiped out. The gold doesn't disappear, it just changes hands, from weak hands to strong hands, from paper holders to physical holders, from retail accounts to institutional vaults. You don't fight this hard against something that doesn't matter. Every time they deploy this mechanism, they're telling you something important about gold's role in the system. They're showing you their hand. Now, I know some of you are scared right now. You watched your portfolio drop and you're wondering if you made a mistake. You're asking yourself if gold is done, if the bull market is over, if you should cut your losses and move on. I understand that fear. It's human. It's designed to make you act emotionally at exactly the wrong moment. But let me offer you a different framework. The question isn't whether gold went down on your screen. The question is whether anything fundamental changed about why you owned gold in the first place. Did government debt get paid off? Did central banks stop printing money? Did inflation return to 2% and stay there? Did geopolitical tensions resolve? If the answer to those questions is no, then the paper price movement didn't change reality. It changed your psychology. And that's exactly what it was designed to do. I know some of you are confused. You're looking at conflicting information, and you don't know what to believe. Technical analysts are drawing lines on charts. Macro analysts are talking about dollar cycles. Conspiracy theorists are screaming about manipulation. And you're caught in the middle, paralyzed by information overload. Here's my suggestion: simplify. The paper market is a casino. The physical market is a vault. Know which one you're in. If you're trading futures with leverage, you're in the casino, and the house can change the rules whenever it wants. If you're holding physical metal or allocated gold in a reputable vault, you're in a different game entirely. You don't get margin called on a gold coin in your safe. You don't get liquidated on allocated metal in Zurich. Paper versus physical. Screen versus reality. The distinction matters more now than ever. And some of you, maybe a smaller group, you actually understand what's happening. You've seen this pattern before. You know that volatility creates opportunity. You know that every liquidation event is a transfer of wealth from those who don't understand the mechanism to those who do. To you, I have only one thing to say. Stay patient. The mechanism is visible now. The pattern is documented. What happens next depends on factors none of us can predict with certainty, but the long-term thesis hasn't changed. Governments are still running deficits. Central banks are still trapped between inflation and recession. The paper financial system is still built on promises that mathematically cannot be kept. Gold doesn't care about any of that drama. Gold just sits there, maintaining its purchasing power over centuries, waiting for the paper system to acknowledge reality. Let me be absolutely clear one more time. This is not financial advice. I don't know your situation, your risk tolerance, your time horizon, or your financial goals. I'm not telling you to do anything. I'm showing you a mechanism that exists, a pattern that repeats, and a divergence between paper and physical that has implications no one on financial television will explain. What you do with that information is entirely your decision and your responsibility. I'm not your advisor. I'm not your guru. I'm just someone who spent years watching this game and documenting what I see. So where does that leave us? They call it volatility. The financial media will use that word like it explains something. Volatility. As if the move was random. As if it was just markets being markets. But volatility doesn't explain why the CME changed margins when it did. Volatility doesn't explain why physical premiums widened while paper prices crashed. Volatility doesn't explain why this same pattern appears in 2008, in 2011, in 2020, and now again. I don't call it volatility. I call it the system showing you its hand. The question is whether you're paying attention, or whether you're going to keep being surprised every time the mechanism activates. The gold didn't disappear. The gold doesn't care about your screen. The gold is sitting in vaults around the world, unchanged by futures liquidations and margin hikes and algorithmic trading. What changed was the price on your screen, which is just a number generated by a paper market that the operators can adjust whenever they need to shake out weak hands. Paper versus physical. Screen versus reality. You don't fight this hard against something that doesn't matter. And they fight very, very hard against gold. That tells you everything you need to know about its importance. So here's my question for you, and I genuinely want to hear your answer in the comments. After everything I've shown you today, the timeline, the mechanism, the historical pattern, the paper versus physical divergence, what's your move? Are you holding through this and accumulating more during the fear? Are you selling because you've lost confidence in the thesis? Or are you waiting on the sidelines, watching to see what happens next? There's no wrong answer. There's only your answer, based on your situation and your understanding of what's actually happening. If this video opened your eyes to something you hadn't considered, do me a favor, share it with one person who panicked during the drop. Share it with someone who sold at the worst possible moment because they didn't understand the mechanism. Information is the only defense we have against a system designed to extract wealth from those who don't understand how it operates. Subscribe if you want to keep seeing these breakdowns. Turn on notifications so you don't miss the next one. And remember, the hidden economy isn't hidden because it's secret, it's hidden because most people don't want to look. This is Jack Goldsman. I'll see you in the next one.